Why is energy such an important thing? Lower energy prices effectively will reduce the price of everything, because if you look at food is expensive because of the energy costs that are required to create food in terms of farming, powering your tractor, heating a barn to keep your livestock warm,
right?
Transporting the finished product around, refrigerating it, all of that requires energy. Lower energy prices gets passed on to food. You also see that across a raft of other things too. In manufacturing, for example, the cost of petrol or gasoline, as they say over there, to get around is at over $6 a gallon, which is, I've never seen anything close to that in my time over in the US. Getting that down is important too, because one of the biggest fixed costs for most households is filling your car up with fuel. You don't get a choice. If amber lights come on your car saying it needs fuel and you go, oh, it's like $2.05 a litre, don't think I want to pay that, I'll carry on driving, you don't get that choice, you have to fill it. And as a consequence, it actually is a significant tax on household income with that higher energy burden. So if there's a reduction in red tape and legislation that enables the energy production sector to get back to its full straps, that's probably a good thing for the US economy. It's a good thing for US population. It's a good thing from a quality of life and cost of living perspective. Bearing in mind that energy prices are actually global, it's good for everybody having lower energy prices. Hey guys, welcome to this week's Money Investing Show. Well, hot on the heels of the US presidential election, we're going to do a bit of a decoding of exactly what's transpired and, more importantly, what impacts we expect to see the 47th president and the policies that go alongside that have on both the stock market, the economy, and for the greater economic environment that we all live in. A lot to digest in here. We've put a lot of effort into this to make sure that it's a very neutral view and purely and simply based on policy. So make sure you take plenty of notes, and as always, do make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Good to be here, Mr. B. Thank you very much for having me. Jam-packed episode installed today because we're going to be decoding the most recent US presidential election and talking about the effect on the stock market, which so far has been really, really good for markets. Indeed.
It was probably the biggest event of the year, at least up until now. There's still a bit of the year left to go, and a surprising for many outcome, not for all, and certainly a resounding victory for the Republicans, not just in terms of the presidential outcome, which is obviously a big win for Donald Trump at 312 electoral college votes, but also the Senate and Congress as well, which are really material when it comes to legislation. So it leaves the Republican Party in a very enviable position of having both hands on the steering wheel for controlling the economy.
Absolutely, and I think, look, for our listeners out there, there's bits and bobs that we're getting. You might see it on Channel 9 on the news, or read a little bit in the paper, or see something pop up on Facebook. Yep. But I guess here our goal is to really break this down as to what happened,
exactly,
what the impact is.
It's also really hard to be objective with this. I've done a few media interviews over the last week or so, and that objectivity in trying to look at what policy impacts and impacts on markets rather than personality, I think is crucial at this stage.
Yep. Okay, so let's go through the results. So 312 states, or 312 votes, I should say, or seats, and a couple of key battleground states won. From my understanding, key ones like Michigan, Wisconsin, Pennsylvania, they were big wins.
Georgia too, as well as Nevada and Arizona. So all the swing states that were up for grabs, toss-ups as they're called, certainly swung toward the Republican Party. And again, that kind of, and a popular vote too, I might add, which is unusual. And I think that kind of significant voice is something people have to listen to. And so, it was an election that was quite heated and quite toxic at times from both sides, and now it's time to really look at what the policy potential is, and noting, of course, that it's January 6th when the inauguration happens, and officially these policies and government takes seat and can move forward. But markets are forward-looking, so I think the response that we saw out of the stock market in particular last week is the interpretation of where they see things going into the future, because markets are forward-looking.
That's right. Before we go into results and impact on the market, AB, let's chat about some of those policies which the Republican government are looking at implementing. Let's start with tax.
So changing tax code. There are actually tax legislation that was put in the previous Trump administration, which is oftentimes these codes have an expiry, and it's almost like a trial. And so there are several tax code changes that technically would expire fairly shortly, but the magnitude of when that we're seeing will mean that they get effectively rubber stamped into legislation, you would think. So the main sort of views on this would be reducing corporate tax.
Okay.
And again, this is a sort of divisive thing, because on one side you can hear an argument that it's not fair that companies are making all this money and not paying their fair share of tax. The other side of the argument from an economics perspective is that when companies operate in a lower tax threshold, number one, if you think about tech companies that have got offshoots in the Netherlands or Ireland so that they don't have to pay tax in the US, it means that most of that money is likely to come back to the US and actually be repatriated and therefore taxed. So you've got a bigger tax collect, even though it's at a lower percentage rate. That's one argument for that.
Okay.
But more importantly, when companies are operating on a lower tax rate, there are several things that can happen. Those benefits can flow through in terms of margins on products can be tighter, employees can be better looked after, and also the stakeholders in the business, which of course typically is a shareholder, typically would expect to see a stronger run from their stock that they hold too, because the company is effectively more profitable. And there are two arguments there. One is that's the rich getting richer, but a stronger stock market is good for everybody, because everyone that has a pension fund is invested in the stock market. And if the stock market grows, your pension fund or your managed investments or mutual funds in the US are also growing too, and a rising tide does lift all ships.
Indeed. On the corporate trend right now, there's been talks of corporate deregulation to a certain extent. What exactly does that involve? What impact will that have?
Look, potentially it goes through a number of different areas. One might be as far as construction is concerned. Most certainly one will be in the energy space too. And if we just sort of break that back to Australia for a moment and see what the challenges we have in our local economy and how red tape can really stop that. If we look at the demand or need for new housing in Australia, the housing affordability scheme that was launched and really hasn't done nothing, it's been a fizzer, as we've covered on here previously, of course, is been snarled up because the red tape involved with getting housing approvals has been this quicksand to try and wade through. So no one's advocating getting rid of all legislation, but making it easier for business to do business with less impact on decision making is key. We saw again that, talking about Australia for a moment, in New South Wales, whereby there were plans for a mine, all the research had been done on it, and then all of a sudden at the 12th hour it was cancelled for various reasons that were put forward by the New South Wales government. Getting rid of that kind of regulation so that business can get on and employ people to create product that people consume, that enables people to eat more cheaply and enjoy a better quality of life ultimately, is, I suspect, what one of the major drivers would be in there in terms of cutting out some of the red tape. Now, very specifically, when you look in the energy sector, one of the major platforms for the Republican Party and the Trump mandate is to have a significant resumption of fracking activity, which from an environmental point of view, and we're not going to get into the greenery, if you will, of this particular view as to whether fracking is good or not good. Having the ability to increase oil production from the US perspective is a massively important economic policy, and a lot of that has been hamstrung with red tape and legislation preventing it from happening. And if that were, if that were removed, the ability for, as President Trump refers, that black gold to be pumped is key. Why is energy such an important thing? Lower energy prices effectively will reduce the price of everything. Because if you look at food is expensive because of the energy costs that are required to create food in terms of farming, powering your tractor, heating a barn to keep your livestock warm,
right?
Transporting the finished product around, refrigerating it, all of that requires energy. Lower energy prices gets passed on to food. You also see that across a raft of other things too. In manufacturing, for example, the cost of petrol or gasoline, as they say over there, to get around is at over $6 a gallon, which is, I've never seen anything close to that in my time over in the US. Getting that down is important too, because one of the biggest fixed costs for most households is filling your car up with fuel. You don't get a choice. If amber lights come on your car saying it needs fuel and you go, oh, it's like $2.05 a litre, don't think I want to pay that, I'll carry on driving, you don't get that choice, you have to fill it. And as a consequence, it actually is a significant tax on household income with that higher energy burden. So if there's a reduction in red tape and legislation that enables the energy production sector to get back to its full straps, that's probably a good thing for the US economy. It's a good thing for US the population. It's a good thing from a quality of life and cost of living perspective. Bearing in mind that energy prices are actually global, it's good for everybody having lower energy prices. And there were some significant measures that were taken under the Biden administration in particular, one of which was the Inflation Reduction Act. And part and parcel of that was tapping the US's strategic petroleum reserve. So the US holds 700 million barrels. I forget what the quantum is, but it's a lot of oil at Pershing and different places around the States as its strategic reserve. So that it's always got, and in fact, Australia's reserves are kept in the US as an aside, little tidbit for you. And those reserves were very, very heavily depleted as the Biden administration released millions of barrels of that into the economy to try and reduce oil prices. On the other side of the coin, OPEC cut production, so it didn't actually push oil prices down, it kept them up. And now the US doesn't have as much strategic reserve there. And what's more, the previous administration, the Biden administration, of course, cancelled we're going to replace all that oil that we've taken out. They've just gone, it's too expensive, we're not going to bother now. So having a lower energy price will also enable the US to reboost its strategic petroleum reserve too. So it's a very, very, very important part of the Trump mandate. Interesting.
And there's a couple of things I'm going to ask you later on as we get through: lower corporate taxes, lower energy prices, the effect that might have on the economy. Before we do, though, any policy shift in regards to spending on behalf of the Republicans?
Look, I don't think it's going to be a conservative budget in terms of spending. And in fact, if you look at some of the flagship policies, for example, immigration and border control is going to be something that's going to soak up a substantial amount of budget. I saw something the other day that was talking about a cost of something like $88 billion over a 10-year window to effectively look to purge America of the illegal immigrants that are there, which is a huge number. And I guess the counter argument to that Tom Holman put back the other way was that, what price do you put on national security at the end of the day?
Gotcha.
So, it's a yin and a yang there. So, I don't think it's going to be a conservative administration from a spending perspective. And in all fairness, there's been an enormous amount of investment and spending that's come out of the Biden administration, again, on previous infrastructure bills and things like that. So there's already locked in spending that's baked in from, the previous 4-year administration, which is always the case in politics in the West, where, the term served is about 4 years, sometimes a little less, sometimes a little more, and you typically do inherit the policies from the previous government to have to then follow through. So, there is likely to be a decent amount of spending. I suppose, where do you look on the other side of the coin to where that money comes from if you're looking at an environment where you're talking about cutting taxes, for example? And I think US foreign policy, and it's really interesting to see. I love all this, and I hope it's sort of shedding a little light on it for our audience that perhaps aren't as interested, but realise it's important to understand. If we look at the direction that US foreign policy is likely to take under a Trump administration, the situation in the Ukraine, for example, which pre-election, President Trump was talking about the fact that we can get this resolved very quickly. If that situation is resolved quickly, and who knows quite, I know we were talking about it a little earlier in the trading room, what that could potentially look like. The billions and billions of dollars that are currently going in aid to fund that war and support the Ukraine all of a sudden stops, and that money then stays domestically within the economy. So you can then redeploy that money to other things. So instead of perhaps funding the Ukraine in a war that hopefully gets stopped very, very quickly, it's sad indictment that it's gone on for this long, that funding that's already there can then be deployed elsewhere, and border security, and I suspect is going to be a big part of that.
Interesting. I think that covers the major policy points. AB, let's talk now about the effect on the stock market. If we look at last week, without wishing to date this podcast, the S&P 500 up nearly 5% just last week. The NASDAQ a little better, up nearly 6%. And the best of all was the Russell 2000, which is the small cap index in the US, up 8.5% just for last week. Why?
I think there's a level, a perception at least, that a Republican administration is probably better for business. We've talked about tax cuts already, and markets like the idea of that. And the US has gone through, quite an interesting sort of 8-year period. If you think about the current Biden administration and Trump 45, in that they've been quite contrasting. So you've had a real change, and then a real change, and then it swung back to the original sort of pace again. And the vision, I think, that's laid out is likely to be a positive for the US businesses. The notion of tariffs, for example, which is something we didn't talk about as a headline policy, but nonetheless starts to have a really granular effect on the stock market. The widely held belief is if you put in tariffs, you're using protectionism to support your own companies, which is the whole purpose of it. To have a stronger domestic economy, to employ more people, to have more profitable companies that employ more people, that make great products, that enables you to increase your productivity and have a stronger economy, employ more people, all the things that go alongside that economic theory. The flip side too, so that's one of the reasons I think why you've seen a lot of the companies have a bit of a bump on that, because all of a sudden they've got an umbrella protecting them from competition in the global market if those tariffs are implemented, which I suspect they will be. The other side from tariffs is that, well, the argument against it is that it means your imports are now going to become more expensive. And that is true. And the idea of taxing imports is to make them, if you're a consumer and you've got an imported product, which is now, let's use the figure of 200%, which is one of the numbers that was banded around in the pre-election conversation, all of a sudden you've got a double the price good that's sat there. And you've now got a choice of buying something that's maybe a local brand or something now that's prohibitively expensive that's imported for overseas. So the consumer is most likely to choose a local brand. So again, it's a positive use of tariffs to price your overseas competitors out of the domestic demand within your market. But where I feel that one of the nuances, I think, of the potential policy around tariffs that a lot of people have maybe missed or have got caught up in the headline of, oh, it's just going to be inflationary, is this notion, and again, and this was a really interesting thing that came out of the Joe Rogan interview, actually, which was a major talking point in the run-up to the election. And that's that if you have a company that manufactures offshore and you say, listen, we're going to tariff you 200% if we import your stuff, or why don't you go and build a factory or a plant in America and employ American people and pay corporate tax in America, and we won't tariff you at all.
It's a great deal, you would think, right?
All of a sudden, you're going to build a factory and you're going to employ local people and pay tax in that market, and you avoid paying the tariff. The net rub-off for the US, of course, is you've employment and a domestic onshoring, if you will, of that kind of manufacturing. And I suspect that stick and carrot technique is how the Trump administration will likely use tariffs as a tool. And I've seen this firsthand in the UK. When the UK was part of the European Union, Japanese car manufacturers used to build plants in the UK. They'd get a government subsidy to do that when economic times were a bit tougher. So the cars were built in the UK, and therefore they could export them all over Europe without there being a tariff on importing into the European Union. So it's a very well tried and tested approach. It creates jobs and it creates a stronger economy. In fact, the town I grew up in Swindon, Honda opened a massive factory there, employed tens of thousands of people at one point doing that. So, if it's used in the right way, not just as a stick, but also with a carrot, tariffs don't necessarily have to be inflationary. They can be used as a way of steering and really pushing for an onshoring of jobs to employ people back into manufacturing, which was a big talking point, especially in some of the swing states like Michigan and Pennsylvania.
Gotcha.
So they're big election points there. So tariffs are huge.
Absolutely. So when we look at the stock market then more specifically, as you say, good for US-based businesses, hence, pretty decent rally last week.
Stronger US dollar, 2% jump against the Aussie just in last week as
That's
well.
Right.
So that whole perception of a far stronger economy coming over the top is very much held by markets.
So three really strong sectors that stood out to me was real estate, utilities, as well as financial stocks. Any reason why they would perform the best in that current environment?
Well, I think if you take the handbrake off real estate, you've been in a situation in the US where interest rates have been, and it's probably worth noting just on interest rates. Sorry, I'm doing a weave here.
I know we've got plenty of plates spinning right now.
I think the other notion that potentially is a bit of a change of view, and this certainly was reflected by markets last week, is that the cuts to interest rates in this cycle may be a little bit slower coming through now because you've got a stronger economy potentially with all of these economic policies kicking in, which may slow the Fed down in their decision to cut rates. I know it was talked of that we want to get rates cheaper so people can borrow, but that will be determined by inflation. And if you've got a much stronger economy, then the chances are inflation doesn't drop as quickly, and therefore rates may stay higher, which then affects trades, for example, in the bond market, like TMF, which we're invested in,
Yep.
where you don't see the jump in bond prices that you were expecting to see as quickly as you were looking to see it.
I think yields are, this is looking at the 10-year Treasury yields, they're at about their 3-month high.
Yeah.
So they did sell off initially, but they've
Yeah.
perked up a little bit recently.
And that's not unexpected in the face of that stuff. So circling back to the sectors that are likely to run, if you think about real estate, we talked about housing approvals is probably the biggest leading indicator there, which if you've got lots of red tape, getting housing approvals through is harder, which means it's harder for people to build, and therefore real estate as a sector is stymied not only with higher interest rates, but also with an absence of supply. And one of the really interesting things in the US over the last couple of years, and they learned a lot from the GFC, is that the majority of property owners have long-term fixed rate mortgages, 30-year fixed, for example. So when interest rates moved higher, you go, well, look, I'm borrowing at this right now, which was probably set at, a sub 2% interest rate for 30 years. And I could move, but I'm going to have to refinance it maybe 6%. That's not very attractive. I'll stay where I am. A movement into an increase in supply, which potentially has more new buyers coming into the market, and ultimately lower interest rates make it more fluid for people then to start moving around. So I think the real estate sector will likely do quite well. It's also a great employer as well from a productivity perspective. As we know from our experience in Australia, if there's money thrown at that sector, it tends to have a really strong knock-on effect elsewhere. So that's the real estate side. Financial services, house always wins. If the economy is doing really well, then the financial services sector does very well. If the economy is not doing so well, typically the financial services sector does quite well.
Cyclical, right?
Particularly when you've had higher interest rates and that margin for between lending and savings rates has been a little bit fatter for banks too. So I think just a stronger level of economic activity is likely to be a great kick along, particularly for that. And then utilities, we've talked about the energy space, and utilities and energy are quite closely related. There's an enormous amount of infrastructure investment needed in utilities in the US because you've had brownouts and blackouts, for example, in a lot of areas in California, and California particularly being driven, no pun intended, by this desire for a net zero and EVs everywhere, needs to have a significant amount of reinvestment into its power grid in order to make that a reality. So it's not just about being able to generate and create energy, you've got to get it to the marketplace, which requires a significant upgrade of the grid. So I think that might be an area that you start to see more government spending going into as well. Although the whole conversation with EVs under a Trump 47 mandate, where everything is back to let's have oil and let's not go too far down this EV pathway, is a really interesting juxtaposition when you see the involvement of people like Elon Musk in the campaign, who obviously through Tesla has got enormous exposure to EVs. So it's going to be very, very interesting to see how that pans out. I think the appointments that we've seen to date and the people that are in the orbit of the campaign, I think we're going to see some very, very different things out of this administration as it moves forward. And again, by having control of a very, very firm grip on the controls of the politics there across Congress, Senate, is likely to see some major defining moments for US. And when the dust settles, we've got January 6th to get through, and I think we will see civil unrest, unfortunately, as we get to that point in time. I hope and pray, like everybody, we don't, but I suspect the reality, and given how partisan things have been, we may see that. A smooth transition of power and an implementation of robust economic policies, and I would not at all be surprised to see if this run in the stock market continues as we hope it does.
Well, as we come to the back end of the episode, AB, if I can ask, and I'll quote some statistics actually I'd like to add in just in regards to that, the outlook moving forward. So if I quote a report from Citigroup, 1 year after a presidential election, the S&P 500 traditionally adds on average about 11% gain. Bonds are usually around 4 or 5% in terms of yields, and then gold prices are traditionally quite flat, likely because there's less uncertainty, I would suspect, in the political landscape. So equity prices are usually quite strong after an election 12 months following. Are there any particular reasons why we would see that, if we can draw interest rates, GDP, corporate profits into those reasons?
I think markets hate uncertainty. So in the run-up to what we've obviously had, which, according to the pundits on the way in, was a knife-edge election, obviously the reality has been quite different from that. And I think, to be fair, markets, the stock market in particular, and to an extent priced in a Trump win, well before. That uncertainty is now in the rearview mirror, and it's now about delivering on the policies that were stated. And that we've run through already in terms of, none of those things are quick to implement. They're all going to take time to do. So it's a question of prioritizing them into what's an immediate priority and everything running through there. Things like tax adjustments, it's a long process to get that approved through the judicial system and political system, I beg your pardon, in the US. But the notion of presidential decrees, which is something that's been done previously, is a way of fast-tracking some of that stuff and then subsequently later getting it ratified at a Congress and Senate level. So it'll be interesting to see what is the A1 priority. I think border control is very likely to be that, purely and simply because it was such an enormous pillar within the campaign, and we've already seen the appointment of Tom Hollimoren, I think it was, as the new borders are, which will be interesting. Moving into the economic space, it'll be, I suspect energy is likely to be front and center for that. And as I've alluded to in this particular conversation, the impact that then has on getting inflation down by reducing people's cost of living is really significant. Interestingly, we've seen a terrific run out of crypto, which is something that was commented on as well. And as we know, Bitcoin as a proxy for crypto has a very, very close correlation with the Dow. And if we see a stronger equity market, I'd expect to see a continuation of that run also in the crypto space too. So certainly halcyon times ahead, potentially, depending on how the transition of power and appointments go. But it's great to have such a massive event of uncertainty now in the rearview mirror, and we know ballpark what that chessboard looks like in terms of where the pieces are. You can start to make a game plan for how you're going to play it, because now you're not guessing who's going to win. You've actually got an outcome, which is crucially important.
Absolutely. Thank you very much, AB. Great insight today.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.